This conference will now be recorded.
I almost hate to touch anything since it's sensitive. But with the accrued revenues, we're talking about the situation of a type 15 and a type 3. So as you remember, with a type 15, we perform the work and we earn the revenue, but we collect the cash later. And so when we do the work, it's a type 15, debit account receivable and credit sales. And then when we collect the cash, it's a type 3 where we debit cash and a credit account receivable. That is, in effect, how, you know, that's in effect how the type 3s. And then type 4 is accrued liabilities. And I'll pull it up in just a second. With a type 1 and a type 2, a cash transaction has already occurred before the adjusting entry. Now, the adjusting entry itself is not going to have cash in it, but there's a previous cash entry. There's a transaction that's is either had cash or is gonna have cash related to it, and then we make the adjusting entry. That's adjusting entries 1 and 2. For adjusting entries 3 and 4, the cash transaction occurs after the adjusting entry. So for type 3, with a type 3, a Roman numeral 3 accrued revenue, with that one, that is in essence a type 15 where we accrue the revenue, and then a type 3 when we collect the cash. So let's just see. And then we have accrued expenses, where expenses are incurred before we pay for them. So if you work, especially if it gets toward the end of the year, December 31st, you might work on December 31st but not be paid until later. But when the year ends on December 31st, the company has to recognize the expenses that have incurred. So if you work 3 days, you're gonna be paid 2 days later in the year. They still have to recognize that revenue. Okay, so let's look at the example of unearned revenue when a company receives cash prior, no, not the unearned revenue, excuse me. You need to be down at accrued revenue, where the services have been performed or the goods delivered, but the cash has not been received. So we're going to have the adjusting entry made where we accrue the revenue, and then in a subsequent entry, we're going to get the cash. So assume a landscaper performs services weekly for a customer at a fee of $375 weekly and bills the customer monthly. So this is a large corporate account. At the end of the year, an AJE will be made to accrue the revenue when the landscaper collects the cash. The subsequent journal entry is made. So we get to December and 4 weeks are performed, and so we debit account receivable credit sales. That's the 15. And then in the next year, when the cash is received, we simply debit cash and credit account receivable. So that is the accrued revenue, which you've seen. So that's the third adjusting entry, accrued revenue, where a cash transaction occurs after the fact. So you should be fairly familiar with that. Accrued expenses occur too. So accrued expenses can occur when we have incurred expense at the end of the period, but it hadn't been paid, and in a subsequent entry, the liability will be paid. So it's just the opposite of the accrued revenue, where we did the work and then we got cash later. Here we've incurred the expense, but we pay it later. So let's look at one example. Accrued interest can be illustrated by the following example. Assume a company creates a note for $20,000 on May of 2017, and the annual interest rate is 12%, producing an interest of $2,400 annually, or $200 per month. Interest is paid semi-annually on May 1st and November 1st. So on November 1st, a regular interest made, debiting interest expense, crediting cash, a type 9. Okay. When the year end comes on December 31st, when that year end comes, there's a month of interest in December. And so the $400 in interest has been accrued, but it's not going to be paid in the 2018. But you make the adjusting entry because the interest expense is owed. So this is type 17, debit interest expense and credit accrued interest payable. I hope that number is correct. On May 1st, when the interest is paid, the payment will include the amount that's accrued before. So we debit accrued interest payable for that $400 that had been accrued. Then we debit interest expense and credit cash. So just look at this. I won't give you one on this, but just look at it. Okay. But let's look at one that you should be more familiar with. Accrued wages. And we all work and are paid later. So it says, assume employees are working but are not unpaid until the next, they work and not paid until the next week. And so assume the weekly payroll is $2,500 a week. So the workers at work are paid $2,500 a week. And so that means they're getting $500 a day. And the payroll is paid weekly on Friday. So when Friday comes up, and we have a calendar here, on Friday the 27th, the workers work that week and they're paid, and we make a journal entry debiting salary expense and crediting cash. So this is the journal entry that is made on December 27th when we pay a whole week's interest, a type 9. But if you look at this calendar, and what you're going to see is that the workers will work on the 30th and the 31st, but they're not going to be paid until January. They're not going to be paid until January. So with that being the case, these 2 days that the workers have worked, we've got to accrue this expense and put it in 2017. So since the workers are getting $500 a day for those 2 days, when they work, we're going to make this adjusting entry, debiting salary expense and crediting wages payable. Salary expenses, wages payable for those 2 days. Okay. So we got the 2,500 in the account and the AJE, and the latest ones in there. Then when that Friday comes around and $2,500 is paid to the workers, when $2,500 is paid, we debit wages payable. Okay, so that $1,000 is in there, and we pay them, but the expenses already occurred, so we take out the wages payable. So the salary expense is only $1,500 on the for that year. So we paid $2,500. 1,000 of the interest is recognized in 2017. The other 1,500 is recognized in 2018. So based on this calendar, there's 2 days of interest in 2017. We can't wait to 2018 and make the regular journal entry. This money has to be recorded in 2017, and that's the purpose of the adjusting entry. So once again, summarizing adjusting entries, we have types 3 and 4, accrued revenue and accrued expenses. And the assets are understated and revenues understated when this situation occurs. With accrued expenses, expenses are understated and liabilities are understated. And with a large company, this could be a lot of money. And so the adjusting entry is we debit the appropriate asset and credit revenues for the accrued revenue. And for the expenses, we're going to debit the expenses and credit the liabilities. And then a subsequent entry is going to occur when the cash transaction is going to occur. And so if you look at this chart, you see that when we're dealing with 3, the account is always going to be accounts receivable. We can use interest receivable, but accounts receivable is going to be the debit, and sales is going to be the credit in a type 3. In a type 4, we're going to debit whatever expense it is, and we're going to credit the liability. So we look at a type 4, our accounts are being listed. It's going to be accrued liabilities. And sometime it could be salary. We'll keep the salaries payable. Everything else is an accrued liability. But we're going to debit expense. It could be office salary expense, AJE 4. It could be interest expense. It could be sales salary expense. So what this chart is showing you is if you have an adjusting entry, what accounts are involved. If it's an AJE 1, or it's an AJE 2, AJE 3, AJE 4. You already told what accounts in here involved. Notice that it's always a balance sheet account and an income statement account, but not cash. Cash is never in the adjusting entry. Are there any questions? Are there any questions?
Yes, sir. I have a question.
Okay.
Do we have access to that chart of accounts with the adjusting entries on it?
Was that in the handout that I sent?
It's on the blackboard as being on course content.
So it's already there. So I sent this, yeah, so it's in there. So all of this is in there, including these problems, so you can turn to them. Let's see if I can find one. Let's look at 27. See if you can work 27. Okay. See if you can work 27. Now, when you work 27, this is simply a 15 and a 3. Okay, so I'm already telling you that. So take 5 minutes and see if you can work number 27. So J.H.J. Rental Company provides 5 limousines to Chase Bank at the rate of $400 per vehicle for a holiday item in December. They don't pay until the next year. So make the adjusting entry, then the subsequent entry to make the payment. Do we have it done? So do I have a volunteer for the adjusting entry? No volunteers?
For the first one, it's going to be accounts receivable. I mean, you're going to type 15, whatever. Accounts receivable, or whatever. You're going to debit 2,000 and credit 2,000 for sales.
That's all that's involved. So we've done this one before.
Yeah.
Debit account receivable and credit sales. And then when they pay us in 2018, what's the entry going to be?
Type 3, you're going to debit cash and credit accounts receivable for the same 2,000.
So this is how the type 3 looks. This is always, see, these are always the journal entries. You just got to calculate the amount. These are always the accounts. Type 15, type 3. So we're just saying this in journal entry because we're showing that, you know, it can be, this can occur in a lot of ways. But the essence of it is that if we have earned the revenue, we got to debit a receivable and credit sales. Could be interest in, you know, accrued interest receivable and interest income. But we're going to debit a receivable and credit sales. Then we collect the cash. We're going to debit cash and credit account receivable. So, of course, everybody should be familiar with this, and you'll see this in that normal format. All right, time for my A students to get to work.
I think mine may be different
Say what?
because my number 27 isn't what your number 27 is. My 27 is 10 limousines to Chase Bank. Huh?
That's 28. But give me 28.
I said it's the
So
same thing. Numbers are different.
yeah. So give me 28.
27 is a 10 limousines instead of 5 limousines.
Yeah, but mine says 26. So, well, for 28, then it will be the
Mine's-
same, 4,000 for
That's
account
correct.
receivables and 4,000 in sales.
Right. So
But
that's correct. You just debit account receivable 4,000, credit sales, debit cash, and credit account receivable 4,000. So if it's different, 'cause I think I just been putting these in you, but this is 27 was up top, and then 28 was below it. So then 29 is 15 limousines. So you just get more and more practice. 30 was 20 limousines.
Basically, yours is different. Your numbers are different. That's the only thing, because our 27 says 10 limousines, our 28 says 15 limousines, our 29 says 20 limousines, and our 30 says 25 limousines. That's the only thing that's different.
Okay. So you're gonna basically see that in the standard way of income earned from corporate customers. So all your study problems have that in there, okay? Everybody looked at their study problems.
Yes.
Almost finished.
Dominique is finished, minus the 2 that I emailed you about that we're going to go over after class.
Okay. Now you got the note, you got the one that I sent you with additional journal entries, correct?
Yep.
Okay. And you're almost finished. Okay. Good. So let's look at 36. Does everybody have the same thing for 36? So JHJ Rental Car Company pays its employees $5,000 for
No, ours is 10,000. Ours says 10,000 for a 5-day work week.
all right, so evidently they're off a number. So everybody, you have this 10,000 for a 5-day work week?
Yeah.
Okay.
yeah,
So I need you to make 3 journal entries. Payment of the regular payroll on December 27th, the adjusting entry on December 31st, and the subsequent entry upon payment of salaries on January 3rd. So make those 3 entries. So you're going to pay the regular payroll. You're going to make the adjusting journal entry on December 31st, and a subsequent entry upon payment of the salaries on January 31st. So everybody has 10,000 for a 5-day work week. Everybody has that. So we need to go to our calendar and given our calendar, make the entry that's going to occur on the 27th, make the entry that's going to occur on December 31st, and then make the entry that's going to occur on January 3rd. So we ready to make our journal entries? So how much are we paying them weekly?
10,000.
So the regular entry is simply going to be what? We're going to debit salary expense for
10,000.
credit cash for 10,000. So how much are we paying them a day?
$2,000.
So how many days did they work and we need to accrue for? 2 days, and they're getting what, $2,000 a day. So this becomes what? 4,000. Well, we want to recognize the expense in 2017. And then in 2018, when we get ready to make the payment, we're going to pay $10,000 again. The worker's going to want their 10,000. But this 4,000 that we accrued for the prior year, we put that here. And the expense is only 6,000. So we have paid them $10,000 again, but 4,000 of the expense was in 2017 for those days they worked.
I have a question.
Yes.
Okay, so I thought when I did it, basically, for the December 31st salary expense, I put $8,000 because from the 27th to the 31st, I counted 4 days. So I thought that we would pay them for 4 days.
It's a 5-day week.
Yeah, I know.
So
we won't count the number of days from the 27th to the 31st.
6/27, then they don't work again until the 30th and 31st.
Okay.
They don't work. We aren't making them work on the weekends.
Okay.
Anybody else has any questions? All right, assume the 10,000 is paid bi-weekly. So instead of weekly, they're paid every other week. So now make these entries. Make the entries if they're paid bi-weekly. Got it done? So we're paying them bi-weekly. When the 27th comes around, they still gonna want $10,000.
Mm-hmm.
But because it's bi-weekly, what? They're only getting $1,000 a day.
So it'd be 2,000.
So it's gonna be 2,000. And then can you make my entry here? 2018.
I put 2,000 for salaries payable, and then 8,000 for salary expense. And then 10,000 for
So these are the accruals, accrued revenue and accrued expense. And a lot of time I might just tell you the amount of the accrual, so sometime I'll just say this amount was accrued. So this kind of shows you how to do it, how the calculation is going to be made, but that's not essential. Okay, so we covered accrued revenue and accrued expense, and we covered unearned income. We now got to go back to prepaid expenses. We're going back to prepaid expenses. So when we're dealing with prepaid expenses, that's the AJE1, so it's going to apply to the supplies and prepaid insurance and depreciation on the long-term assets. So the accounts involved, these are your AJE1 balance sheet accounts, then your AJA1 income statement accounts. And so we said with prepaid expenses, before they occur, the assets are overstated. We don't have all the supplies anymore. And the expenses are understated. And you're always debiting that expense and crediting an asset or contra asset. And there's a preceding companion entry. And so the first one we looked at was supplies. And we said supplies such as paper, pens, etc., are debited to the asset account. But we aren't going to record the supplies daily, make an entry every day. We're going to buy the supplies at 5,000, debit supplies and credit cash. Then we're going to see how much we got in supplies at the end of the period. Then we're going to make an entry debiting supplies expense and crediting supplies for the difference between the amount of supplies that we bought and the amount that we have left. Okay? When we buy the supplies, then it's always the difference between what we bought and what's left. That's the expense. That's what's been utilized. Everybody is expected to be able to do that. Okay. Are there any questions on the supplies adjusting entry? So here, supplies is an adjusting entry that's occurring because of usage. We use something, it's no longer there. Then we have insurance. A lot of time insurance, we buy that to protect us. And insurance is paid for in advance. So when we buy the insurance, it's an asset. So we debit prepaid insurance and credit cash. Here was the case, $24,000 for a 12-month policy on April 1st. So when we buy it, and it's going across the year, so when we buy the insurance policy, we debit prepaid insurance and credit cash. Now, when it rolls around to December 31st of 2017, then we got to expense it's no longer an asset. Time has caused it to expire. So from April 1st until December 31st, that insurance is no longer an asset anymore. It's an expense. How do we calculate it? We had 24,000 in the account for 12 months, so that's 2,000 a month. And so 9 months have gone by, so we just say 9 times 2,000, give us 18,000. That leaves 6,000 in the account. So we debit prepaid insurance, credit cash, and we make the adjusting entry, debit insurance expense and crediting prepaid insurance. Is there any question on that? Everybody can do that. Well, let's work one and then we'll take a break. So when y'all work one problems, we'll take a break. So we're going to work 7 and 8. Are y'all's numbers the same for these? If not, just look at these. So let's just look at 7 and 8. So I'm making them larger. So let's work with these numbers. And it says on April 1, 2017, JHJ Shoe Company purchased a 12-month insurance policy for $1,200. Record the entry to purchase insurance policy on April 1st and the adjusting entry at December 31st. So let's do that one first.
I'm not sure if I'm looking at the right one, but my number 7 has revenue. It looks
Work this one. Just work the one and a half here. This is the 40 journal entries at the adjusting AGs at the back. So just use this 7 and 8 here. So we have 7 finished? Let's not make it hard. We're going to debit, and I think our date is, the date in this one is April 1st. So we bought the insurance, and how much did we pay for it?
$1,200.
$1,200. So we know that this insurance is expiring at the rate of what? It was a 12-month policy. What's it expiring at the rate of?
100.
Mhm.
So therefore, on December 31st, what's our AJE gonna be?
100.
How much?
100.
900?
Yes.
I thought it was supposed to be the 6 months times 100. So won't it be 600?
No, we said we're up here April 1st.
Oh,
But
I
it
was
could,
on the. Okay.
yeah, so some of them say April, some say July, some say September. But just so you know what you're doing, we just said it was April, but then the next one is July. But I just kept this in April, just simply like we did before. Now let's go on to number 8, my A students. So April 1st, 2018, JHJ renewed its insurance coverage at a cost of $1,500. Record the entry to renew the policy on April 1st, with the paying a little bit more, and the adjusting entry on December 31st. Your adjusting entry should reflect the balance in the prepaid insurance account on January 1. So what we're going to do here? Well, can we buy the new policy for $1,500? Let's buy the new policy for $1,500. So suppose this is your cell phone bill, and your cell phone bill, you got it on April 1st of 2017 for $100 a month. Then when 2018 came around, you're paying $1,500 a month. How much money are you going to pay for the cell phone company in 2018? That's the question. That's your rent. And if your rent goes from $1,200 to $1,500 on April 1st, how much rent would you pay in 2018? Do you know? Everybody got a cell phone? So can you calculate it?
Would it be 2025? That's what I got anyways.
How'd you get 2025?
Cause first with the new policy, it was $1,500. So I divided that by 12, and it comes to $125 a month or whatever. We already, with the insurance expense, we already debited $900 for the first part. So
So for January to March, how much were we paying? How much was being expensed? $100 a month for what? $300.
Oh, I did the times. So first part.
But from April
So
December,
it's 1425.
we're paying how much?
125.
125 a month. So
Yes.
125 times 9 is how much?
1125.
I'll take
Which
your word for it. So the total payment that we're going to make is what?
1425.
So you're doing this all the time. You got a cell phone or you're paying rent when it changes. So when you get your lease at the beginning of the period, you're paying one thing. When you get the next year, when you look at how much you pay in 2018, it's going to be the old amount and then the new amount too. So we simply debit insurance expense 1,425 A students, B students, and credit prepaid insurance 1,425. Okay, we're going to take a break for about 10 minutes, and when we come back, we will be moving to our final adjusting entry that we're looking at, long-term assets. So review the information on long-term assets. We're going to cover how to calculate depreciation. So you have that for your study problems. Then we're going to make the adjusting entry at the end of the year for long-term assets. So let's take a break and then we'll come back to that.
This conference will now be recorded.
What we want to do now is look at long-term assets and depreciation, talk about those, and then we'll get into the adjusting entries. So the current assets, as we said, are at the top of the balance sheet. Those assets convert to cash within a year. The non-current assets, property, plant, and equipment, are expected to last more than a year. So, we have the current assets, then we have property, plant, and equipment. And we're always subtracting the accumulated depreciation to get the net. So the balance, you got to be subtracting that accumulated depreciation. And then these intangibles, goodwill, patents, and trademarks. All of these items are not current items. They are items that are going to have a life over a year. But in here with buildings, we don't depreciate land. But with buildings and equipment and autos and everything, we do expense them. It's just that it's over a period of time. And so when we buy these assets, they're going to become expenses, and you got to have revenues to cover them. Okay, so that's always the case. Depreciation, a couple things are important. We record the items at cost, and then we match it. So we got these items, these long-term assets. We got to match them with the revenue. Okay, so that's always the case. So depreciation, this little definition, a systematic and rational process of distributing the cost of tangible assets over the life. It's a process of allocating costs. And there are various methods to allocate that cost. We're only working with two: straight line depreciation and declining balance. So we're only working with two. This example sort of shows you what's happening. Suppose you buy a car costing $4,000 and it has a 4-year life. When we buy the car, it's worth $4,000. At the end of the year, if it's depreciated $1,000 a year, it's worth $3,000. At the end of the second year, $2,000. End of the third year, $1,000. End of the fourth year, it's not worth anything. And so that's how depreciation is working, because this asset is turning into an expense, just from cars in general. They go down in value. And so if you're running a company, you got to reflect that decline in value and offset it against the revenue. You can't be showing revenue and not all costs, because eventually we have to replace these items. When we buy the asset, we make the following journal entry. We could debit equipment and credit cash, or equipment, cash, and notes payable. So that's that standard journal entry. Here we just use the 7. When we get ready to record depreciation in year 1, we're going to debit depreciation expense and credit accumulate depreciation for $1,000. And we do that because we always want to know what the equipment costs. But this accumulate depreciation is a contra asset account. It keeps a credit balance and it's subtracted to get us to the net book value of what the equipment is worth. So that's the standard thing. So the AJE, debit depreciation expense, credit accumulate depreciation, we could credit equipment, but because it's a long-lived asset and we want to know the original cost, we credit accumulate depreciation, and then we subtract that from cost to come up with the net book value, basically what it's worth. When we get to year 2, the good thing about these journal entries, in this case a straight line, the same journal entry is made. Debit depreciation expense, credit accumulate depreciation, same journal entry. But now the equipment has a cost of $4,000, but the accumulated depreciation is now $2,000, and the item is worth $2,000. By the time we get to the 4th year, we would have completely depreciated the item and its cost was 0. So we bought a $4,000 item. We've expensed it. Hopefully it's generated revenue. So that's all depreciation is doing. It's coming up reflecting the fact that this item is an expense. It's prepaid asset initially, but then we got to expense it over its life. So over a 4-year life, every year there's an expense of $1,000 was revenue generated to cover this expense. There are 2 methods of calculating depreciation: straight line and double declining balance that we'll be using. Various other methods, but we're using these 2 methods. In the straight line method, we determine the total cost. If there's any salvage, we're going to reduce it by the salvage. We're going to divide 100% by the life, and that's going to give us the applicable depreciation. So let's see if we can look at an example. Assume that we had an asset that cost $50,000, its salvage was $10,000, and its life was 10 years. Let's look at how the depreciation chart would look. The cost is $50,000. The cost minus salvage is $40,000. So we subtract out the salvage. Our depreciation rate is going to be 100% divided by the life. So that's 10%. So the 100 just stays that way, divided by the light. That's how we get our straight line rate, which is the same as dividing by 10. But so that we understand double declining balance better, we do it this way. So we take 10% of the cost minus salary, and the expense is $4,000 a year. So it stays the same every year. But the accumulated depreciation keeps increasing, 4, 8, 12. So by the time we get to the 10th year, we depreciated 40,000. And so the 40 minus the 50 gives us that salvage. So we never depreciate it below salvage. So that's why we subtract out the salvage. So that's how straight line depreciation works. We get the cost, we subtract out the salvage, 10,000, this is what we're going to depreciate. We divide 100%, that's always the same by the line, to come up with this 10% rate. 10% times 40 is 4,000. So at the end of the first year, the accumulated depreciation is 4,000. And then the second year, another 4,008. Third year, another 4,012. And we continue with that process. Is there any issue of how we calculate straight line depreciation? So that's pretty straightforward. Sometimes we want to write off more than the straight line amount. So a lot of time assets, if you know, if an automobile, as soon as you drive it off the lot, it's declined by 10 or 15%. So sometime we're going to calculate depreciation where we're going to depreciate a lot more initially. So it can be any declining amount, but let's go double declining. So when we go with double declining, we determine the total cost. But now to get our rate, we're going to divide 200% by the life. So rather than 100% by the life, it's 200% by the life. In year one, we multiply the cost by the rate. In year two, we're going to reduce the cost by the previous depreciation and multiply by that rate again. And so we're going to get a declining rate. So let's look at an example. So you saw how it looked with straight line, the same depreciation each year. If we're doing double declining balance, first of all, the cost is 50,000. Our book value is always the cost minus accumulated depreciation of the prior year. So in the first year, we got the 50,000. The rate is 200% divided by the life, not 100% divided by the life, but 200% divided by the life. And so now we're writing off 20%. We take 20% of 50. We don't consider salvage. And so we get 10,000 as the expense. The accumulated depreciation is 10,000. So that's how the first year looks. The total cost, ignore salvage, get a rate based on 200% divided by the life. So 200 divided by 10 years, 20%. We take 20% of 50,000. And so the accumulated depreciation is 10,000. Now, when we get ready to go to year two, it's going to be 50,000 minus whatever is in line 6 for the prior year. Now, remember, in column 6 for the prior year was 0 when we first got the asset, but now we have $10,000. And so it's 50 minus the 10 gives us 40. We apply the rate at 20%, and we get $8,000. So we got 10 the first year, it's 8 the second year. Now our accumulated depreciation is 18,000. 50 minus the 18 gives us 32,000 the third year. Times 20%, 6,400. Our accumulated depreciation is 24,000. And we continue in that process of applying a 20% rate, subtracting that from the cost, and applying a 20% rate again. Now, if we compare the depreciation, if you remember, it was 4,000 every year for straight line. With double declining balance, it's 10, then 8, then 6, 5, 4. Then it drops until it gets to a point when it's 40,000. So we still cannot depreciate below 40, but we don't utilize in our calculation. This gives us a higher tax write-off initially. And so our taxes are reduced. And so that's why this method is used. Okay. Any questions on depreciation and how we calculate it? So we're simply recording the cost. So we should be able now to, since we understand depreciation, easily knock out these adjusting entries, correct?
Are we dividing or multiplying?
Multiplying.
Okay.
So we're multiplying. Okay, to get the rate, we divide. Okay, so the DDB rate is 200 divided by the life. The straight line is 100% divided by the life. So to get the rate, we are dividing. But then to calculate the expense, we multiply. So we get a rate, then we multiply. Any questions? So we'll just go back over that, later. But I just wanted to go ahead and hit at that while we were with adjusting interest, so that the adjusting interest would make a little bit more sense. Plus, you'd be able to work on your study problems and do things you needed to do. So we should have covered just about everything that you need for your study problems, I believe. But we'll look at that after we finish up. Let's see if we can get back to these adjusting entries. Okay, so we're dealing with the final prepaid expense. So we're familiar with this. Do you have 13 5 autos at 20,000? If not, just move to the one that has the 5 autos. So we got the 5 autos purchased for 20,000, each paying 50,000 down. So can we make that journal entry to buy the autos?
Yeah, we're buying the autos. It's gonna be auto for debit 100,000, and then cash will be 50,000 down.
Make the journal entry to buy them, make the adjusting entry at the end of the period, and then show me the balance sheet presentation. And we don't have salvage here, so we don't have any salvage. Because our focus here is just on, okay, making the adjusting entry. So there's no salvage. Find the asset, make the adjusting entry for depreciation, and show the balance sheet presentation. Got our journal entry made?
Yep.
So we debit our total how much?
100,000.
Credit cash,
50,000.
credit note payable. We've made that entry.
50,000.
So what's our depreciation expense gonna be?
25,000.
So 4-year life divided in that. So that's 25% is the rate. 25, 0, 0, 0. And so the nice thing about this is what?
All years
Yeah,
gonna be the same.
Gonna be the same. Copy. So every year, the adjusting entry is the same. So once you got it calculated for each year, the adjusting entry is going to be the same. Now let's look at our cost less depreciation for our net cost. In the
100.
first year, 100,000. Depreciation is what?
25,000.
So our net cost is what?
75,000.
Second year,
100,000.
you make depreciation now.
50,000.
So our net cost,
50,000.
net book value. In the third year,
100,000.
depreciation 75, net cost 25,000. So that's all that's involved with that adjusting entry. So we have now covered all the adjusting entries. Are there any questions on anything that we've talked about today? Are there any questions on anything we talked about? So the adjusting entries are not meant to be hard. You just got to calculate the amount and they just fall in there. So hopefully you see the process. terms of how they come in there, but they're not meant to be hard. Tomorrow, we begin on cash and receivables in the cash flow statement. So we begin on that last statement, the cash flow statement. And we have a template for it, so it's really not going to be that hard to do. Not going to be that hard to do. Any questions by anyone? So we got it all down pat there? See, if you've got the journal entry down, then you should be okay. So these are some more, but they're just little add-ons. They're not the major things. So adjusting entries are not major. I mean, they sort of throw people off, but those other journal entries are much more important generally. Okay, so they aren't major. You go, you calculate them, make it, and go on. So you had a question, Darius?
No, not so much of a question. I think I just may have to like rewatch the video again, just to
Okay.
like drill it into my head so I can get an understanding fully. I mean, I understand, but I think I watch it again, it'll help me get what I know.
Okay. Christopher? Crystal,
Yeah, I'm getting it. It's just, yeah, I just gotta go back through it and just really focus on specific parts of it.
Okay. Crystal? Okay. Roquel? Salandra?
I'm just have to go over it again. Just look over it again. Just review. But I'm getting it.
Okay. James?
I'm starting to get the basics of it, but I really just got to watch the video again to actually understand it.
Okay. So once again, we'll hit it with the study problem. But what we did before is much more important that you have that down. So yeah, you got to make these little calculations and do it, and you got to think. You say, I'm not telling you the number. But the other things of going through the process of getting to the trial balance and the financial statements and the closing entries, that still is the key. And so you see in your problems, most of the journal entries are regular journal entries. There are always just a few adjusting entries. Okay, there are only a few. So look at them, work on them, make a decision. We understand. We'll go from there. Okay, so I have a couple of students, people who have questions they want to work with. So everybody else can go ahead and leave, and we'll start back tomorrow.